Welcome to my channel, Finance of History, Money, Power, and News Together. Please subscribe to now. Thank you. In the 1980s, Japan was an economic titan, the envy of the world. It was the planet's second largest economy, a manufacturing powerhouse, and a symbol of what a nation could achieve. To many, it seemed Japan's rise was unstoppable. Fast forward 3 decades, and the story is starkly different. While still a prosperous, high-income country, Japan has endured the longest period of economic stagnation ever recorded in a major advanced economy. This isn't a story of a single catastrophe, but a slow, grinding journey through what's often called the lost decades. So, what really happened? How did the economic sun of the land of the rising sun seem to set for so long? Let's rewind to the late 1980s. Japan was in the grip of one of the largest asset price bubbles in modern history. It all started with a major international agreement in 1985 called the Plaza Accord. The goal was to weaken the US dollar, but for Japan, it meant the yen skyrocketed in value. Suddenly, Japanese exports became much more expensive for the rest of the world. To counteract this and keep the economy humming, the Bank of Japan did something that seemed logical at the time. It slashed interest rates, making it incredibly cheap to borrow money. This lit the fuse on an economic powder keg. With credit flowing freely, money poured into the stock market and real estate. The results were mind-boggling. The Nikkei stock index soared to unimaginable heights, reaching nearly 39,000. By the end of 1989, land prices went ballistic. At its peak, a small patch of land in central Tokyo was valued higher than all the real estate in California. It was a frenzy of speculation, a national belief that prices would only go up. But all bubbles must burst. Worried about this runaway speculation, the Bank of Japan slammed on the brakes. Between 1989 and 1990, it hiked interest rates 5 times. The party was over. The stock market crashed spectacularly in early 1990, and land prices began a relentless decline that would last for more than a decade. This collapse wasn't just about investors losing money. It shook the very foundations of Japan's financial system. Banks were left holding mountains of bad loans. They had lent enormous sums of money, using hyperinflated real estate and stocks as collateral. Now, that collateral was worth a fraction of its former value. Many banks were technically insolvent, but instead of forcing a quick, painful cleanup, the government hesitated. They allowed these zombie banks to continue operating, hoping the economy would magically recover and fix the problem. It didn't. Throughout the early 1990s, the government tried to jumpstart the economy with massive spending on public works projects, building bridges and roads across the country, but it was like trying to fill a leaking bucket. Real growth flatlined, averaging less than 1%. By 1995, with the economy still sputtering, the Bank of Japan cut interest rates to near zero. Yet, a new, more insidious problem was taking hold. Deflation. Prices began to fall. While that might sound good for consumers, it's a nightmare for an economy. Why buy something today when it will be cheaper tomorrow? This expectation of falling prices caused both consumers and businesses to hoard cash and delay spending, creating a vicious cycle. Just as things couldn't seem to get worse, they did. In 1997, in an attempt to get its own finances in order, the government raised the consumption tax. This move sucked demand out of the economy at the worst possible time. The country officially fell into recession, and the crisis was amplified by the Asian financial crises unfolding next door. Finally, in 1998, the government was forced to act decisively on the banking crisis. They injected huge amounts of public money to save major banks and stabilize the system. The immediate crisis was averted, but the damage was done. Banks, focused on repairing their own broken balance sheets, were extremely reluctant to lend, starving businesses of the credit they needed to grow. By 1999, Japan entered uncharted territory. The Bank of Japan introduced its zero interest rate policy, or ZIRP. Interest rates were effectively zero, meaning conventional monetary policy had run out of ammunition. 2 years later, in 2001, they pioneered a new strategy that would later become famous worldwide: quantitative easing, or QE. The central bank started pumping massive amounts of money directly into the financial system. It was a radical experiment, but still, inflation refused to budge. The early 2000s saw a brief period of recovery, largely thanks to a boom in exports to a rapidly growing China. But this relief was temporary and masked the underlying weakness in Japan's domestic economy. When the 2008 global financial crisis hit, demand for Japan's exports collapsed, and the country was plunged back into recession, with deflationary pressures returning with a vengeance. By 2010, Japan's nominal GDP, the size of its economy in yen, was still lower than it had been back in 1997. It was a truly lost decade, and then some. In 2013, a new government under Prime Minister Shinzo Abe launched an ambitious plan, dubbed Abenomics. It was a three-pronged attack: aggressive monetary easing, fiscal stimulus, and structural reforms. The Bank of Japan went all in, promising to do whatever it took to hit a 2% inflation target. The yen weakened, boosting corporate profits, and for a short time, it looked like it might be working. But a crucial piece of the puzzle was missing: wage growth. Companies were making more money, but they weren't passing it on to their employees. Without higher wages, people didn't feel confident enough to spend more, and the deflationary mindset remained entrenched. While all this was happening, a powerful, silent force was reshaping Japan's economy. Demographics. Japan's working-age population had been shrinking since the 1990s. The country has one of the oldest populations in the world, and its total population has been declining since 2008. This has profound economic consequences. A smaller workforce means lower potential growth. An aging population means higher social security and healthcare costs, putting immense strain on government finances. In fact, Japan's public debt has ballooned to over 200% of its GDP, the highest among advanced economies. The bubble's collapse also permanently changed the psychology of Japanese companies. Having been burned so badly, they became incredibly cautious. Instead of investing in new projects and expansion, they focused on paying down debt and hoarding cash. This corporate risk aversion created another drag on economic growth. So, when we look back at Japan's long stagnation, it's clear there's no single culprit. It wasn't some mysterious cultural trait or one bad decision. It was a perfect storm: the collapse of an unprecedented asset bubble, a delayed and timid response to the ensuing banking crises, the stubborn grip of deflation, a shrinking and aging population, and a corporate sector that became afraid to invest. Each factor fed into the others, creating a cycle that was incredibly difficult to break. Today, Japan remains a stable, wealthy, and technologically advanced nation. But its three-decade struggle offers a profound lesson for the rest of the world. It has a case study in how quickly economic fortunes can change, and a cautionary tale about the dangers of asset bubbles, deflation, and demographic decline. The economic puzzle that is modern Japan continues to be studied by policymakers everywhere, hoping to avoid a similar fate. Thank you for watching. If you found this explanation helpful, please consider liking this video and subscribing for more deep dives into the forces that shape our world.